What if I told you that no bull market has ever started without a follow-through day? In today's video, I'm going to show you exactly what that is and what to look for. This is from William O'Neill's work, How to Make Money in Stocks. Let's get into it. Welcome back, everybody, to the show. We're taking a look at the daily chart of the S&P 500. And I have some stuff labeled here on the screen, and I want to start walking you through what specifically that it is that I look for to start to feel more confident that the market might turn back around. And this is by far fact-based. The history is there. This is something that really does make me feel significantly more confident, but it doesn't mean go all in when we start to see this pan out. And I'll show you why and what it is that I personally do, and I have added additional elements into this specific process. What I'm pointing out here on the screen is some recent price action, right? We just hit a pretty significant low, volatility spiked, and this right here we're marking as the potential bottom, right? The potential, I say, because we don't know if it's the bottom yet. And now what we do is look for an attempted rally. And the attempted rally just means that we're going to have a day move higher, another day, and as we progress, we don't take out this prior low. So as you can see, I labeled 1 and 2 right here. The main key to this aspect is looking for what's known as a follow-through day. A follow-through day is when the S&P 500 will be up 1.2% or higher on higher volume than the previous day. More specifically, we look for the follow-through day between the days 4 and 7. Now, it can go a little bit more. That's totally fine. But typically, we want it at least after a couple of days of moving sideways. So as you can see right now, we're at day 2, going into day 3. As long as this low can hold, when we start crossing past day 4, we start to look for a very bullish day with higher volume than the prior trading day and making sure that it's about that amount. So right now, this is what's known as the attempted rally phase. And yes, today was a very, very interesting day, how we gapped up and we came right back down. But we'll get more into that. So let me show you some previous examples of what a follow-through day might look like. This is a chart of 2023, the most recent time we went through a correction in the S&P 500. And as you'll notice here, we established a low and we had some attempted rallies over here, day 1, day 2, day 3, day 4, day 5, day 6, day 7, day 8, day 9. And it wasn't until day 10 where we actually had a bigger than 1.2% day on higher volume than the day prior. Now, we did see some monster gaps along the way, but this would have been that confirmation signal, happens to be breaking the prior high over here, so that actually established a new high, a higher high than what we've been seeing in this from higher lows. So this one came right at around here, and we know what happened after that point. The market continued to rally. If we go into 2022, this is the bear market bottom in October. I remember this very clearly, and where I was, we had a horrible inflation report and ended up closing higher on the day, a big reversal bar. But let's do the count here. So this would be technically day 1 of the attempted rally, and it would be the established low. This would be day 2, day 3, day 4, day 5, day 6, and it just so happens day 7 we had that big up day on higher than normal volume. And at this point, you can feel a little bit more confident about looking for individual stocks to trade, that the bull market may be starting to peek its head back up. This is a look at the pandemic, which we're well aware of all that volatility that stepped in. And let's take a look right here where this specific follow-through day is. Now, this was the low. This was the first day of the attempted rally. We had day 2, day 3, day 4, and now we're really starting to look to see if we can get a follow-through day. So 5, 6, down a little bit, 7, 8, 9, and boom, on 10, we then had higher than normal volume, and it was up a 1.2% or more, and actually crossed above this prior swing high. So a few things from a technical basis, that would have been the follow-through day where you start now to try to put in and execute more exposure into the markets. This is 2018. Now, this one is a little interesting to me because you can approach this in a couple of ways. So we had the established low right here and the attempted rally. That right there was a huge day in and of itself, right, closing at the high. So this would be day 1, day 2, day 3, day 4, day 5, day 6, and then boom, Day 7, this was a big up day, and we had about matching volume between the prior day. So if you want to be very, very, very specific, that one wouldn't technically be considered our follow-through day up until this range. However, if I was looking at this and using, soft guidelines, I would say this just crossed above this high. After a pretty gnarly down day and seeing this, I would be looking to execute into that and updating a stop and going from that point. But if you happen to wait, you would have missed just, a little move right from here, right? And then you would have gotten a little bit later, but that would have still been catching a great move overall in the S&P 500. Now let's go to the financial crisis, right? People might be wondering about 2008, right? 2009. Well, here was an established low of the financial crisis. And yeah, I'm not showing the entire financial crisis on this chart. I'm zooming into the bottom. Okay, that's the low. You have your just inside day. The attempted rally is actually right here. So this is day 1, 2, 3, 4. Okay, now I'm starting to look for a follow through day. 5, 6, right? This one looked good, but it was on less volume. And I believe that this was actually almost matching volume, just like the 2008 case. But the very next day definitely saw a move of 2+%, and it was on higher than normal volume. So this right here would have been that follow through day. And I would then start to obviously add exposure into the market. So I'm going to go back over here to the S&P 500 and just remind everyone that, hey, this is only day 2 of an attempted rally. We're still holding above this low, and we're going to be looking for day 3, day 4, and from that point, start to really look for a follow-through day to feel a little bit more confident so that we can ignore what's on the headlines, what's in the news. It doesn't matter at that point. Now, I want to be very clear. This process, it has marked every start of a bull market. No bull market has started, but there's many false attempts. The probabilities of it working out are around, I believe, they say about, I forget the study exactly. I think it was anywhere between 40 and 50% of the time it fails. So it does have a decent fail rate. However, what I like to do when I'm looking at this is look at a couple other elements, such as I like to trade the looking at the expected moves. I like to look at the 5-day moving average and the direction of it. And I like to look if we're above or below the gamma flip line, which we'll go into here in a moment. Then, when I know that this is starting to build up, and maybe we do get our follow-through day, say over here on day 7, day 8, whatever the case may be. If that is the case, I don't just put in 100% back into the markets because I know that the markets can fail. But I do then start to add a little bit more exposure. And what I watch out for are what's known as distribution days. So after our first follow-through day, it's important to make sure that you're keeping an eye out for distribution days. What is a distribution day? A distribution day is a day that's down on more volume than the prior day. Okay, so for example, this right here was a day that was down from the prior day on more volume. So this right here was considered a distribution day. So after we get our follow-through day, if we get our follow-through day while we're in this attempted rally phase, if we start getting distribution days thereafter, it's a time to be very, very cautious and make sure to be continuing to manage that risk. Now, yesterday I posted this specific chart about the expected moves for the daily basis, and you might be wondering what these numbers here. This is just thinking of it in terms of a distribution curve, right? 68% of the times, that's 1 standard deviation. 95% of the times, that it'll close within this range, that's 2 standard deviations. And these moves, this range, these levels, are based off of implied volatility. And today, you can see we actually gapped up. Everyone was so excited. Where do we go to? We went right into what was expected for the day. And that 30-second opening candle, we didn't actually close above it. We ended up closing below it and starting to trend back down. Now, this was pretty clear through the day that we would see a downtrend, and there was a very clear signal as to what that was. So if you do watch something like Market Net Flow and you're not trying to fight what the market is currently doing, this tool right here can be found in the Discord channel. I post it there sometimes, or you can type it in the query channel to get your update. But what you'll notice here is the green line was above the red line. So the market was in a bullish divergence, right? These are the cumulative net premiums for calls, and then the red line's the puts. But they both crossed below the 0 line, pretty much right at around this range. So this white line's the spine, it went up. And then if it's below the 0 line, they're both below there, but we have this green convergence, right? This one's specifically something that I post, the one in the query channel, just momentum. but all convergence tells you is the price of SPY moving with market net flow? Okay, so if it's not, it turns gray, and that is what it is. As you'll notice, they're both below this zero line right here. So that right there tells me that we can see chop anyway. But what was interesting was when we started to get this crossover where the cumulative net premiums for puts started to rise up and the call cumulative net premiums started to kind of flatline. Then you have the red line start to go above zero and you start to notice red convergence. And during that entire time, what is the SPY doing? It's starting to notify us, right, that the SPY, the price of the S&P 500, is moving with that market net flow for that day. And that right there would have been a clear tell sign to say, hey, you know, if you are trying to buy the dip, be very careful by managing your risk and having tight stops, but only playing very key specific levels. So you might be wondering, once again, what does tomorrow look like? This is tomorrow's expected range, and it's quite large. Once again, we're looking at over $7 for the S&P 500. So we have a range up to and around 528. That's based off of the VIX. And then right here, which is about 526, that's the upper side. To the downside, we have I'm just going to round up to 512 for the expected move for the day. And then also just around 510 for the lower one, which is based off of the VIX. And then that is the 2 standard deviation move, which there's a 95% chance we close there. Now, remember, there's also 3 standard deviation moves. That would, go up even further. But that is kind of what we're looking at going into tomorrow's range of risk that the market is currently pricing in. Now, we talked about how to find a potential market bottom. No bull market has started without that follow-through day. Now, I want to just tell you one other thing that I'm going to be looking for, and that is going to be if whether or not, when that happens, if we're going to be in positive gamma territory. I find that this is going to be an incredibly helpful tool moving forward because this tells us how dealers are going to really hedge. So when we are above a gamma flip line, that allows us to know that volatility can subside, liquidity can increase, and dealers, they look to buy the dip, sell the rip, buy the dip, sell the rip, buy the dip, sell the rip. But when you're below a gamma flip line, things change. Volatility increases, liquidity dries up, sellers sell into selling, buyers buy into buying, sellers sell into selling, buyers buy into buying. It becomes significantly more volatile. Now, going into tomorrow's trading session, there are a couple of key levels from a gamma perspective you want to pay attention to. That's going to be 5,100, 5,150, and then 5,000 is starting to grow in some size right here. That's going to be the downside watch. We'll see where the gamma flip line updates in the morning, but as it stands right now, I think that's at 5,430. Okay, and then above us, we can see that we've been kind of getting chopped up and around that 5,300 marker. I want to go over one other thing here, and that's the 5-day moving average. It is still in a decline phase, right? So people were calling out it's a bear flag, and absolutely we start to see a breakdown. We saw a little bit of a bounce right at this channel right here earlier in the trading session, and that could have been some short coverings, a little bit of a pop, or people trying to buy a little dip, or whatever the case may be. But market net flow never changed during this time. So we saw the bounce. So if you're tactical, cool, but you got to manage risk, and boom, we're trading right there at around that weekly expected move. So right now, as it stands for me personally, you can go to my Twitter and look at my P&L curve if you want to. I'm about, what did I say? I was 25% invested into the markets, so pretty small amount. And I'm paying attention to see how this plays out for volatility kind of decrease a little bit, see if we get our follow-through day, start to see us price action get above that 5-day moving average for it to start flattening out. And then most importantly here too, I also want to see us go back into a positive gamma regime. And until that all takes place, I'm going to be having a lower position into the market, lower exposure into the markets, but I may trade here and there, but probably be out for the most part just to protect my capital as we're in a time of higher volatility. Hope today's episode helped out everybody. That's all I got. See you later.